Two Canadians buy identical homes on the same street. They earn the same income, make the same mortgage payments, and live the same life. Yet 20 years later, one is stuck with nothing but a house, while the other has that exact house, plus a separate $250,000 investment portfolio. Same life, completely different result. Here is the legal strategy creating that gap: the Smith Manoeuvre. Imagine making payments for decades only to discover a legal trick could have generated a massive second nest egg on the bank's dime, and you completely missed it. Let's break down the math. Today, we are putting Canada's most powerful wealth strategy under the microscope. Does it actually work? We are performing a live lab check. The numbers do not lie. Your Canadian mortgage is a financial trap because every payment is made with after-tax dollars. At a 40% marginal tax rate, you must earn $1.66 just to pay one single dollar of interest to the bank. The rest is eaten by income tax. But investment loans are treated completely differently. Watch how the system flips right here. The CRA lets you deduct interest if the borrowed money is used to buy income-generating assets. To break the after-tax trap, you need a Re-advanceable Mortgage, which links your traditional mortgage to a home equity line of credit, or HELOC. Most Canadians never see this part. This is the part most people misunderstand. It operates as a continuous loop. You make your standard mortgage payment. Your principal debt drops. Instantly, that exact amount of paid down principal unlocks as available credit inside your HELOC. This is the step banks never explain clearly. You draw that money out of the HELOC, transfer it to a separate investment account, and buy income-generating assets, creating a brand new tax deduction. This is where most Canadians unknowingly leave equity sitting idle. This is also the point where the strategy either works or fails completely. Let's break down the exact math, step by step. Step 1. You borrow $100,000 inside your HELOC at a 6% variable interest rate. That means your annual interest payment is $6,000. Step 2. Here is where it changes. At a 40% tax rate, that $6,000 deduction triggers a $2,400 tax refund. The result? Your true out-of-pocket interest cost drops to $3,600. Mathematically, your effective borrowing cost instantly falls from 6% to approximately 3.6%. This is the same tax principle sophisticated investors use to cut the cost of borrowing. To keep the CRA happy, you invest in blue-chip dividend stocks or broad market index ETFs. When they distribute income, you inject that cash right back as a lump sum payment straight into your primary mortgage. This crushes your bad debt even faster, which instantly opens up more room on your HELOC to buy more assets. Look at how compounding accelerates the numbers over a 20-year horizon, assuming a 6% HELOC rate and a 7% investment return. By year 5, your portfolio crosses $35,000. By year 10, it hits $90,000. By year 15, you are at $170,000. And by year 20, your portfolio surpasses $250,000, while your primary mortgage is entirely wiped out. Without investing separately, the traditional path leaves you with only the house. The Smith Manoeuvre leaves you with the house plus the portfolio. Before you execute, we need a reality check. This is leveraged investing with borrowed money. HELOC rates are variable. Make sure your budget can handle higher payments if rates rise, and ensure you can hold the line if the market drops 20%. Second, beware of the paper trail trap. If you use even $1 of that HELOC to buy groceries or pay a personal bill, you contaminate the loan and destroy the tax deduction. You must maintain an immaculate, isolated paper trail straight into the investment account. To execute safely, follow 3 steps. Number 1. Get a mortgage broker who explicitly understands re-advanceable products. Number 2, open a dedicated, separate investing account used exclusively for this strategy. Number 3, work with a qualified tax accountant to file your deductions perfectly. Most Canadians spend 25 years trying to eliminate debt. But the real question is, what if that debt could actually work for you? That's the experiment, and now you know how it works. Knowing your numbers is your biggest advantage. Drop a comment below, hit subscribe to stay ahead of the Canadian housing market, and I will see you next time.